All right, let's get right into it. Today, we're unpacking a real head-scratcher from this earnings season, Sprinklr's second quarter report. Now, on the surface, everything looked fantastic, a real home run. But the way the market reacted, well, that told a completely different story. So let's break down exactly what went on here. And here's the paradox right up front. On the left, you've got the results, a clean beat, and they even raised their guidance for the full year. I mean, that's what you want to see, right? Textbook great quarter. But then you look at the reaction on the right. The stock gets absolutely hammered, dropping 10%. So the big question we have to answer is, why? So, to really get why the market freaked out, we got to start with the good stuff. We have to appreciate just how solid these numbers looked on paper. Seriously, by all accounts, this was a very strong quarter that gave investors plenty to be happy about. First up, let's talk earnings per share. Sprinklr delivered 13 cents. Now that's a non-GAAP number, so it's adjusted for some one-off items. But here's the kicker. Wall Street was only expecting 10 cents. So they didn't just beat expectations, they totally blew past them by 30%. That's a huge beat. Then, of course, you've got the top line, the revenue. It came in at a cool $212 million. That's up 8% from the same time last year. And again, this wasn't even close. It sailed past what analysts were predicting by more than $6.5 million. So, strong growth, another clean beat. And for me, this number right here is where the story about good execution really shines, an 18% non-GAAP operating margin. Now, get this. Just last year, that number was only 10%. To see that kind of expansion in just a year, wow. It just shows some serious operating discipline and that they're keeping a tight rein on costs. So let's pull it all together for a second. You've got a beat on revenue, a beat on earnings per share, and a massive jump in margins. And hey, let's not forget the nearly $30 million in free cash flow and adding 3 new huge customers who are paying over $1 million a year. On paper, this is the picture of a healthy, really well-run software company.
Okay, so the numbers look good, but beyond the spreadsheet, management is trying to sell Wall Street a much bigger story. It's a story about a company in the middle of a transformation with a new strategic focus that they believe is going to create a ton of value down the road.
And right at the heart of this story is something called Project Bear Hug. It's exactly what it sounds like. They're basically giving their top 700 customers, who, by the way, make up almost all of their revenue, a big ol' hug. The whole idea is to get closer, fix any lingering problems, and really fight to keep their business. And it seems to be working. They mentioned the number of challenged accounts is already dropping.
They're also talking up what they call an ambidextrous strategy. Think of it like they're trying to do 2 big things at once. On one hand, they're pouring energy back into their classic core products. And on the other hand, they're investing heavily to grow their newer high-potential business in the contact center space, or CCaaS.
And here's the CEO, Rory Reid, basically telling everyone, hey, just hang with us for a little longer. He's saying he believes all these investments and this intense focus on execution are going to start paying off really soon, and that we'll see a real bend in the company's trajectory. Now, to make all this happen, they're bringing in the big guns. A new chief revenue officer from Dell who has a deep background in AI sales. A new head of services from Philips. We're talking seasoned executives here. But, and this is a big but, look at that last name on the list. That one change caused a whole lot of concern. And that brings us to it, the climax of the story. With all this good news, great numbers, and a really compelling turnaround story, why in the world did the stock plunge? Well, it turns out the market looked right past all the good stuff in Q2 and honed in on a few critical red flags. This, right here, is probably the number one reason. After posting that strong $212 million in revenue, management turned around and guided for Q3 to be lower sequentially. For a growth-oriented software company, seeing revenue go down from one quarter to the next is a major warning sign. It signals that growth is slowing down, and investors hate that kind of uncertainty. So yeah, here they are, the 4 big reasons for the stock drop. That weaker Q3 guidance was a huge one. Then you have the sudden departure of the CFO, Manish Sarin, which always spooks investors and creates a sense of instability. And all of this just feeds into this bigger fear that maybe the execution issues aren't solved and that customer churn is still a problem they're wrestling with. So with all that context, the good, the bad, and the really uncertain, let's shift gears. It's time to put on our analyst hats and figure out what this all means for investors and for the stock going forward. This is the question that everyone's asking now, right? After all that, what's the move? Is this a great buying opportunity after a temporary dip? Or is this a warning sign of deeper problems? In other words, what's the trade? To answer that, we're going to break it down for you in a simple 3-step framework. First, we'll predict what we think will happen with the Q3 results. Then we'll forecast how the stock is likely to behave. And finally, we'll wrap it all up with our official rating.
Okay, so here's our call. We think Sprinklr is probably going to meet its lowered Q3 guidance. Why? Because management set a very achievable, very prudent bar for themselves. But we expect the stock price to basically be stuck in neutral, just bouncing around in a range. The market is in total wait-and-see mode right now. It needs proof, and that proof has to come in the form of real, tangible wins from that new CRO and clarity on who's taking over the CFO job for good.
And that brings us to our final reading for Sprinklr. Market perform. Now, this is a neutral stance. On one hand, you have to be impressed by their operational discipline and those expanding margins. But on the other hand, you just can't ignore the very real uncertainty around their near-term growth and this leadership shuffle. It's a classic show-me story. They have to prove the turnaround is real. And of course, we always have to say it, but it's important, this analysis is purely for informational purposes. This is not financial advice. So we'll leave you with this final thought. Sprinklr has put a lot of its chips on its new AI-focused chief revenue officer. Is he the catalyst they need? Can he rewrite the narrative and prove this transformation is the real deal? Or are the challenges here a little deeper, meaning this turnaround story is really just in its opening chapter? That's what we'll all be watching for next quarter.